Beginner's Guide to Understanding Cryptocurrency. Can you recall the time when you finally understood the concept of cryptocurrency and realized that it involved more than just Bitcoin? As you slowly educate yourself about it, you learn that there are numerous other coins, tokens, and decentralized applications, each with their own distinct use cases and features. However, there are still so many people who don't understand it. They don't have a clue what it is or how its system works. Well, this is pretty normal because cryptocurrency can be really confusing to beginners. In this video, I'm going to teach you the fundamentals of cryptocurrency, and hopefully, this will inspire you to give it a try. Education plays a crucial role in the widespread adoption of cryptocurrency. However, it's not easy for everyone to grasp the fundamentals of crypto, as concepts like blockchain, mining, and staking can be challenging to understand. That's why today I want to share some tips on how to explain the whole concept of cryptocurrency in a way that other people will understand easily. Based on my personal experience, the first question you'll likely receive when discussing cryptocurrencies with friends and family is, what is cryptocurrency? Here's how I usually answer that question. Cryptocurrencies, in simple terms, are digital currencies. They function similarly to regular currencies, but instead of physical cash, they exist entirely in digital form. Each cryptocurrency coin is essentially a string of alphanumeric characters. While this may sound complex, it's not too different from how traditional currencies work. Let me explain further. Most physical currency bills around the world have a unique serial number that contains details such as the date and place of printing. In theory, a central bank keeps a record of all printed bills and their whereabouts. This information is then shared with other banks and the government. Similarly, if you have a debit or credit card, you'll have an account number and PIN that you use to access your funds. When opening an account, you provide personal information such as your name and address, which your bank, the central bank, and the government are aware of. Suppose you have a $20 bill with the serial number XYZ, and your bank account number is 1111. When you deposit that bill into your account, your bank branch, the central bank, and the government will verify that the $20 bill with the serial number XYZ has been transferred to bank account number 1111. This is similar to how cryptocurrencies operate. In essence, each cryptocurrency coin is akin to the serial number found on the physical bill but without the physical currency. Just like regular bills, almost every cryptocurrency can be divided into smaller units. In the case of Bitcoin, each BTC can be subdivided into 100 million units called satoshis, which are comparable to cents in a dollar. A cryptocurrency wallet address is similar to a bank account, except there is no physical card associated with it. It's just a unique account number. Unlike with a bank account, you don't need to provide any personal information to create a cryptocurrency wallet. This means that your identity is not linked to your crypto wallet in the same way it is with a bank account. Perhaps the most crucial aspect of holding cryptocurrency in your personal wallet is that you have direct ownership of it. Unlike regular money held in a bank account, which is custodianized by the bank, any cryptocurrency held in your wallet is directly under your control. This means that no one can shut down your cryptocurrency wallet or block your transactions, as you have complete authority over that account at all times. When it comes to cryptocurrency, the records of transaction and account balances are stored on all the computers connected to the cryptocurrency network instead of being kept by banks or the government. These records are public and can be viewed through a blockchain explorer. By processing transactions on the cryptocurrency network, computers can earn cryptocurrency, which incentivizes more computers to join the network and process transactions. This decentralized setup makes cryptocurrency networks secure because there's no single point of failure, unlike the centralized setups of governments and banks. To clarify, traditional digital currencies created by banks are not the same as cryptocurrencies. These digital currencies represent a centralized payment network that some may view as potentially dystopian. When it comes to cryptocurrencies, you might have heard about Bitcoin and Dogecoin, but there are actually thousands of different cryptocurrencies out there, just like there are different regular currencies such as US dollars, euros, and Japanese yen. However, not all cryptocurrencies are designed to be used for everyday transactions. There are two broad categories of cryptocurrencies: coins and tokens. Coins belong to cryptocurrency networks that were built from scratch by developers who put a lot of time and resources into creating a safe and reliable network. Cryptocurrency coins are a type of cryptocurrency that are given to computers as a reward for processing transactions on a cryptocurrency network. For instance, Bitcoin or BTC is a cryptocurrency coin since the Bitcoin network was created from scratch, and BTC is awarded to the computers that verify transactions on the Bitcoin network. Because creating a cryptocurrency network from scratch is extremely challenging, there are only a few dozen cryptocurrency coins available. Crypto tokens are different from cryptocurrency coins in that they are relatively easy to create and can be done so with minimal effort. This is why there are tens of thousands of tokens in existence, whereas only a few dozen cryptocurrencies are actual coins. One example of a token is the NFT, or non-fungible token, which is likely a digital certificate of ownership for a physical or digital piece of art. However, this is just the beginning of what can be done with tokens. As an example, there is a company named Circle that offers a cryptocurrency token called USDC. This token is fully backed by actual US dollars, which means that for every USDC in circulation, Circle holds $1 in reserve. You can create USDC by exchanging your dollars with Circle and vice versa. Another company, Paxos, offers a cryptocurrency token named PaxG, which is backed by 1 troy ounce of gold stored in a vault in London. You can redeem PaxG tokens for actual physical gold or US dollars. The best part is that both Circle and Paxos are fully regulated in the United States and are regularly audited to ensure that they have the appropriate reserves backing their tokens. This provides a high level of security for investors. When it comes to cryptocurrency tokens, it's crucial to keep in mind that many of them are scams. The main reason behind this is that creating a cryptocurrency token is a simple process, which makes it easy for scammers to create fake tokens. To do this, scammers create a token, set up a flashy website, pay for social media ads, and pay news outlets to feature their token. As a result, they can quickly make a fortune off unsuspecting individuals who are new to the world of crypto. Your friends might ask if cryptocurrencies are safe, given that they have a reputation for being used by scammers and criminals, and that there have been instances of cryptocurrency hacks. When it comes to the safety of cryptocurrencies, there isn't a one-size-fits-all answer. The safety of a cryptocurrency depends on several factors. To begin with, it's important to understand that not all cryptocurrencies are created equal. Some cryptocurrencies prioritize speed over security, and that often leads to consequences. Fortunately, there are always hackers looking to exploit cryptocurrency networks for their own profit by tricking them into creating new coins or tokens out of thin air. Although this may sound frightening, it's no different from what happens to banks and corporations on a daily basis. When hackers succeed, the affected entity typically improves its cybersecurity. The same is true for cryptocurrencies, meaning that most established ones have been extensively tested by being constantly under attack from malicious people. Another reason why cryptocurrencies can be safe is that many networks are decentralized, meaning they rely on a large number of computers distributed globally to verify transactions and balances. This makes it extremely difficult for hackers to corrupt the system because they would have to control over half of the computers connected to the network simultaneously. While some cryptocurrency networks have been hacked in the past, these incidents have typically been resolved quickly and with improved security measures implemented to prevent similar attacks in the future. It's important to consider that some cryptocurrency networks such as Bitcoin have millions of computers distributed worldwide, making it impossible to corrupt the network by hacking more than half of all computers at once. However, other networks with fewer computers are more vulnerable to attack. Also, centralized cryptocurrency services like exchanges are easier to exploit than individual cryptocurrency wallets, which are highly secure. Therefore, it's advisable to keep your cryptocurrency in a personal wallet whenever possible and only use exchanges for trading or cashing out. The most secure option for self-custody is a hardware wallet. It's true that in cases of criminal activity, ransom demands made by hackers often involve some kind of cryptocurrency. Although the cryptocurrency demanded is often Bitcoin, the hackers usually exchange it for a privacy-oriented cryptocurrency like Monero as soon as possible. This is because Bitcoin and most other cryptocurrencies have publicly viewable transactions and wallet balances, making Bitcoin transactions easy to trace by authorities, even more so than regular currencies. Therefore, it makes no sense for criminals to actively use and hold a currency that's so easily traceable. When it comes to cryptocurrencies, there are privacy-oriented ones like Monero that are encrypted and cannot be cracked by the US government, which is impressive. However, the overwhelming majority of cryptocurrencies are not used for criminal purposes, and only a handful are actively used by criminals. The real risk of crypto is related to investing, as they are extremely volatile and their prices can change drastically within a day. Investing too much in crypto can be dangerous, especially when using leverage to trade with borrowed money. Therefore, some people would suggest investing only what you're willing to lose and not more than that. When people ask why cryptocurrencies are so volatile and what gives them value, I usually respond by asking what gives the money in their wallet or bank account any value. In the past, money was backed by gold, but that's no longer the case. Now, all state-issued currencies around the world are losing value because they're ultimately backed by the trust we have in the governments that issue those currencies. Unfortunately, that trust has seemed to tarnish over time. In regard to the value of cryptocurrencies, it's important to note that their worth is derived from their functionality. Of course, the value proposition of each cryptocurrency can vary. Bitcoin, for example, has value due to its limited supply, and its economic profile is often compared to that of gold. With a maximum supply and a decreasing production rate over time, there will only ever be 21 million Bitcoins in existence. Other cryptocurrencies may derive value from their speed or ability to process transactions. Ultimately, the value of a cryptocurrency is tied to its utility and adoption in the market. If we assume that the demand for Bitcoin remains constant, its price would double every 4 years due to its economic profile, which is similar to that of gold. However, demand for Bitcoin has been increasing over time, especially during the current pandemic, as we have become more aware of the weaknesses of regular currencies. As for basic economics, when something has a limited supply but its demand continues to rise, the price will inevitably go up. Many investors also view Bitcoin as a secure place to store their capital outside of the current financial system. It's worth noting that many other cryptocurrencies have a high correlation with Bitcoin, meaning that their prices are affected by Bitcoin's movements. However, some cryptos, like Ethereum, have significant value due to the functionality they offer. For example, the Ethereum network enables the creation of the cryptocurrency tokens mentioned earlier, as well as the creation of a decentralized application and websites that cannot be censored or shut down. Users must pay gas fees with Ether to create and transfer tokens and interact with these applications. This means that the demand for ETH increases as the Ethereum network gains more users, and Ethereum has seen significant adoption. For example, Visa is testing payments on the Ethereum network using the USDC token, and the European Central Bank even issued a bond on their Ethereum blockchain. However, the reason why the value of BTC, ETH, and every other cryptocurrency fluctuates so much each day is that it's difficult to determine their true value. Stock prices, gold prices, and even regular currency exchange rates also fluctuate every day due to the same reason. Cryptocurrencies are much more volatile because of their revolutionary nature. Cryptocurrency networks enable lending, saving, and borrowing without requiring identities, credit scores, or banks. They allow for direct peer-to-peer transactions, eliminating the need for middlemen such as Uber or Facebook to take a cut. They enable communities to pool their funds and democratically decide how they should be spent, which could potentially render governments and politicians unnecessary. The role of cryptocurrencies is immense. Cryptocurrencies have the potential to disrupt the established order and change the way we interact with money and technology. This potential makes crypto investors highly emotional, leading to market volatility. However, in the long term, the growth of crypto seems inevitable. The technology behind cryptocurrencies is constantly evolving and improving, and many businesses and organizations are adopting it. While the future of crypto is uncertain, it's clear that it has a significant role to play in the future of finance and technology. When advising others on which cryptocurrencies to invest in, it's important to make it clear that you're not providing financial or investment advice to avoid potential legal or personal consequences. That being said, the decision about which cryptocurrencies to invest in ultimately depends on the individual's timeline and risk tolerance. You must know that the cryptocurrency market tends to follow a 4-year cycle. Keep in mind that investing in cryptocurrencies is a personal decision that depends on your timeline and risk tolerance. Currently, we're in a bull market phase where prices are gradually rising, but this phase could end as soon as this fall. However, it's unlikely that you'll sell your cryptocurrencies when they're at their highest prices. While most cryptos have seen most of their gains in this bull market, a 2 to 3 times return on investment is still possible, and it's even more likely if you hold until the next crypto bull market. It's worth noting that buying and holding cryptocurrency can give you about the same amount of profit as actively trading, which I don't recommend unless you plan to make it your full-time job. Remember, I can't offer financial or investment advice, so please do your research and invest wisely. To determine your risk tolerance in the crypto market, it's important to know that there are different levels of risk involved. The greater the risk you're willing to take, the higher the potential for reward. One way to gauge the level of risk and reward is by looking at a cryptocurrency's market cap. This metric is crucial because the value of a crypto in dollars can be misleading. To calculate a cryptocurrency's market cap, you need to multiply the coin or token's current value by its circulating supply. Dogecoin has a high market cap due to its large circulating supply of 130 billion and current price of 30 cents. However, achieving a price of $1 would require an additional investment of $80 billion, making it unlikely to happen. While some may see it as a chance to get rich quickly, it's important to remember the investment required to achieve such a high value. As a general rule, cryptocurrencies with smaller market caps have more potential for growth, regardless of their dollar value, because it takes less money to increase their value. A prime example is Yearn Finance's DeFi token, which is worth more than Bitcoin but has a market cap 20 times smaller than Dogecoin. This means that it would take less capital to drive up the price of DeFi. With the exception of Dogecoin and a few others, most of the cryptocurrencies in the top 10 by market cap could be considered low-risk investments. Cryptocurrencies like Bitcoin, Ethereum, and Cardano are likely to remain in the market for many years, and their value will likely double, if not triple, before this bull market is over. In general, the lower a cryptocurrency ranks by market cap, the riskier it is to invest since it takes less capital to significantly affect its price. While there are potentially profitable opportunities outside of the top 10 cryptocurrencies, the risk increases as you move down the list. Cryptocurrencies ranked outside of the top 200 are particularly risky and not worth investing in, as most quality projects have already been established. I hope this gives you some knowledge about cryptocurrency and increases your interest in it. Thank you for watching, and I hope it was helpful. If it was, let me know in the comments. Stay tuned for the next video and have a great day. See you soon.